Basically, when price came down there, you would expect it to have some bounce and some sideways chop. And that's exactly what we've seen here. It doesn't change my view that Bitcoin is not at a bottom yet. Bitcoin in its normal bear market cycles goes down about 80 to 85%. I think it's only down about 70%. And this is the first bear cycle the Federal Reserve has not been printing money during. Yeah, so that's almost one of the reasons as well why I'm kind of leaning towards, if I had to choose, was there to 75 or a 50, I'm going with 50 right now, not only because I think the CPI number is going to come down a little bit and make it more comfortable for the Fed to do 50, but also because they're reducing their balance sheet, which when they reduce their balance sheet, it also works as a tightening measure. So it's almost like they would almost equal 75 basis points by doing 50 basis points and also reducing their balance sheet at the same time. And I think the Fed has to be so careful. Like this is, and again, he has to talk a hawkish game. I understand Jerome Powell, but they have to be so careful that they don't overdo it and push us into a bad recession, because it's not like 5 years ago or 2 years ago or 6 years ago where they can print us out. They can't. And so if they really trigger a bad recession, the economy is going to be stuck in that recession until it figures its own way out. And that, I hope the Federal Reserve is very aware of that. Yeah. So again, when oil was trading, I think even in our last discussion, I said I was generally bearish on oil, even though everyone was saying, oh, it's $115, $120 a barrel. It's going to go to 150 to 200. And the key is this, is that everyone's thought process for why it was going to spike was that Russia's oil wasn't going to be bought and put on the market. So you had this reduction in oil, big reduction in oil that was on the open market. And the reality of it is, I clearly knew from past experiences with Iran that they just sell their oil at a discount to China, to India, to other countries, and other countries are more than willing to take that oil. So you weren't really removing oil off of the open market. In addition, the Federal Reserve tightening, the ECB is tightening, everyone's tightening interest rates. What does that do to the economy? It slows the economy down. So if you have a global slowdown, OPEC just a few days ago was like, oh, we're going to cut 100,000 barrels of production. That means nothing when you have a global slowdown, because you're taking millions of barrels of demand off the table. So I think that's the key, is to look at the economy, the economics of the situation, understand how oil's still going to get out there just at a discount anyways. And it just leads you to believe that I still think oil is going to go lower. You could be due for a bounce. In fact, if we look at the chart here, I always like to show my charts. You could see we actually did recently just hit this trend line, which again, you're seeing a bounce today. We're back to about $86.77. But I think this is just a bounce before we break this line. And I think you're headed into the mid 70s by year end. So I still think there's more downside. And again, it's going to coincide with seeing the economy in the US continue to signal recession potentially. And I think Europe's going that direction, maybe even worse than the US because of the natural gas crisis. And I think most of the world, I think China's already kind of there already due to what I'm hearing as well. Yeah, so Bitcoin's been dancing right around that 20,000 level. And the reason why I was harping on 20,000 is because that happened to be the high from the last bull cycle. So in 2017, we saw this unbelievable percentage move to 20,000, and then the bear market started. Finally, we got into the next bull market. And then basically when price came down there, you would expect it to have some bounce and some sideways chop. And that's exactly what we've seen here. It doesn't change my view that Bitcoin is not at a bottom yet. Bitcoin in its normal bear market cycles goes down about 80 to 85%. I think it's only down about 70%. And this is the first bear cycle the Federal Reserve has not been printing money during it, right? So in every past bear market cycle, the Fed's been printing money with QE and QE1, QE2 and all those. And this is this first cycle it isn't printing money. And that makes me wonder if at least we go down 80 to 85%, which gives me that 12 to 13,000 target, or could we actually go even a little bit lower? So I think that we're still going to see another leg down, minimum 12 to 13,000, and then I'll have to reevaluate if it's going to go lower after that. Yeah, so I think that is a very important aspect about reducing energy, because I know that a lot of fund managers and investment portfolio managers, one of the things that they're always pressured on is being very environmentally conscious, right? So that's going to alleviate that issue. And then also the merge is going to change the way the mining is done, which almost creates it as a deflationary asset, almost like kind of a Bitcoin. So I actually think longer term, this is really bullish for Ethereum. And I do think that it makes it much more attractive to investors overall, not just for the utility purposes, but also for the savings and kind of a different way to invest versus holding US dollars and other currencies, fiat currencies. So I think that's very good. I think the biggest thing next week with the merge is it has to go smoothly, right? So, you know, and this is big for the entire crypto market. Everyone's looking to that. They need to nail it to give the confidence to the crypto markets. If they do, I think you could get a little short-term upside, kind of the relief of, okay, it happened, it went smoothly. It doesn't change the fact that I think eventually Bitcoin's going to 12, 13,000, but in the near term, it should be a positive. Yeah, so I mean, it's finally coming down into that, like that trend line we looked at. That would have been a quick trading opportunity where you go long for a week or two. But I think you have to just look at the economics of the situation and just be really, really careful. You know, with the economy potentially headed towards recession, that's just a reason to be very careful about buying oil here. Again, shorter term trades I think are okay, but be very, very careful. And the other thing I'd point out on natural gas, right? Natural gas was basically guiding investors to expect downside. And I love pointing this out because it's kind of a different view to the retail investor, right? The retail investor is very focused on what is the news media saying, is the hype there, what's going on, you know, Russia. And what we heard was a week ago from today, last Friday, we saw that Russia shut down Nord Stream 1 100%. And there was a 3-day weekend here in the US, Labor Day on Monday, and everyone was like, oh my goodness, you know, natural gas is going to go nuts. And on that Friday, when they announced the shutdown, the stock market fell sharply, but natural gas did not spike. And when you see these disparities in price where fear of a spike is occurring, but underlying price is not spiking, you have to take that as, wait a minute, price is truth, not emotion, and it's going to sell off. And what happened then this week? Natural gas collapsed. So those little things to look for are very, very helpful for investors and traders. Yeah, so uranium's had an amazing move over the last 2 weeks. We're starting to hear about maybe some nuclear power options coming back. If we look at the chart, number one, I mean, this is just a beautiful thing, right? So you had this trend line here, and every time price hit it, come here, 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 it was a buying opportunity. So here what we saw is this downsloping trend line, you broke out. So you've had a short-term breakout on uranium. And this is the URNM, so it's the uranium ETF. But basically what you want to be careful of if you're a uranium investor is you are coming up to another resistance point on the URNM at around 86.50. So just be aware that if you get around 86, price is going to run into a roadblock and it may have trouble. You may get, that might be your level to see a bigger pullback. Now, how big of a pullback, I'm not sure. I think overall, this is a bullish consolidation macro pattern, which means the longer term is still bullish on uranium. But as a shorter term investor, you want to be very careful if price gets to 86, 86.50 and look for a pullback. As an investor, for me, I wouldn't be a buyer here because it's already rallied too much with very little reward left. So I would look for it to hit that level, pull back and consolidate, and I'd be looking to buy that pullback. Yeah, so very, very true. And the number one thing is I think by year end, my price target as of the beginning of the year was about 2,400. That's not going to happen this year. I think you might get back to 2,000 and a half, which would be that high, that triple top high. But the dollar strength has just taken a lot of energy out of the sales of gold, right? So when the dollar goes up, gold generally reacts and goes to the downside. The only thing I would point out, and this is a really cool point about gold, is gold has still been an amazing performer this year. Number one, if you looked at gold in terms of euros, it's having a great year. If you looked at it in terms of yen, it's having an awesome year. In terms of the dollar, not so great, but even then, the dollar's rallied 15% this year, and gold is only down about 4 or 5% for the year. So think about that. In a normal market, if someone told me the dollar was going to be up 15%, I would be like, okay, well, gold should be down 15% then. The fact that it's only down 4 to 5% tells you that it's actually doing its job and holding on to its value very, very well, especially when you compare it to the S&P or Bitcoin or anything else. So I think, again, you have to just say gold is doing its thing. If the dollar, and eventually the dollar will pull back dramatically, then gold will have its big epic move here. What I love seeing is this sideways chop on the daily chart. This again is bullish consolidation, and eventually the probabilities dictate that this pattern eventually breaks to the upside. So again, it's not the sexy mover. We're not seeing those big moves in it, but in reality, it's actually been a very, very solid performer in spite of a really strong dollar, right? So, and this is a great point, is because a lot of people are love the miners because you get a bigger bang for your buck usually. Usually, if gold goes up a little bit, the miners go up a lot more. The reason that hasn't happened and the miners have declined so much is because of inflation, right? So if gold is staying steady and the miners are mining, what's ending up happening to the miners is they still have to purchase equipment, pay people to mine that gold. And we know that wages have gone up dramatically. The price of materials have gone up. So all of their costs for mining have gone up sizably, but the price of gold hasn't gone up. So that's where the disparity comes in, where their earnings are getting hit because of that. So the miners have been under a ton of pressure, but this is the cool part about it. The mining chart, the GDX chart, hit a major support this week at these lows. And I love, the biggest thing for me is these parallel channels where you connect the highs and then you look at where the lows are and look at this area to this area and look at the low this week. And then look at this secondary level right here and how that coincides. And if we zoom in, that's right the low on the GDX. So GDX has already bounced off of it. I would say look for maybe consolidation, and then GDX is a big buy here. My thesis for why I think GDX is going to be good for the next 3 to 6 months is that as you see inflation coming down, I do think the miners start to outperform now. So they were underperforming as inflation was going up and getting scarier and scarier. They should outperform now if inflation does come back in. In fact, one more point, and it's a super intriguing point, is like, so Newmont Mining reported earnings, and one of the things they said is we're going to stop mining in this particular way because it's too costly. And I thought that was fascinating because it reminds me of how Bitcoin does its halvings, where it gets harder or more expensive to mine and it reduces supply. And the idea is as prices go up for mining and mining equipment and labor, these companies are going to mine less because it's too costly. And what that does is it reduces the supply of gold coming onto the open market, which inevitably, if you reduce supply and demand is there, price will inevitably go up. So it's another signal why, and again, this is more of a longer term signal, but it's another signal why demand will go up and price ultimately should go up on gold. Yeah, so I mean, I think at this point, the rally we had from even 2009 when the Fed began printing money was so vertical that it pulled forward a lot of the upside in the market, very much like you saw happen in China about 10, 12 years ago, Brazil 10, 12 years ago. And what's interesting about those markets is they've been chopping sideways for 10 years, actually more than 10 years. And so it's very similar. Like in fact, let me show this chart. I want to show you this because it's super powerful to kind of envision here. So if we go to the monthly chart on the S&P, this was the 90 run, the pullback, the 2000 up to 2007, the pullback. And then this is where the Fed started printing money. And look at that. That is not a natural market move. Now, what's interesting here is if we go to something like the EWZ, which is the Brazil ETF, look at this move on the Brazil ETF. And then again, go back to, put that trend line in, let me erase that. And then go back to the SPX again and look at that same move. It's almost identical, right? The vertical nature. And if you look at the EWZ, which is the Brazil market, the ETF for the Brazil, what did it do after that? It topped out after this ridiculous run, big correction, upside, downside, upside, and basically it's been chopping sideways now since the high in 2008. And so you're now talking 14 years that the Brazil market has not outperformed. And if you look at the Hang Seng market, it's very similar, right? Let me bring up that correct chart here. Bear with me, Hang Seng, there we go. So again, if we look at that chart, you had this monster run from 2003 to 2007, and then look at the chart, how again, it's basically trading currently at levels that it was trading back in 2006. And so you're talking about 16 years of sideways action in the Hang Seng China stock market without a real breakout to the upside. So I look at this move and all I see is the S&P over the last, 11 years, right? Since 2000, since 2009. So back last 12 years, 13 years. So that's my concern, is that we're now entering this phase of the cycle. And again, markets work on cycles, folks. You have to understand that. And so I am concerned we're going to see this, then we're going to see a lot of this for like 10 years before we finally break out. Now, having said that, the question is, well, where do you invest? Well, the two charts I just showed you, to me, you don't want to obviously overinvest. But if I had to choose right now, U.S. market be long or China slash Brazil and some of those countries, the South American countries, I would absolutely be going towards those for the next bull move.